Okay. Yeah, welcome everyone to today's webinar on the mindset shift in RGM from independent tools to holistic solutions. We have a packed session today with some theoretical insights in the beginning, and then we will go into an exclusive tool demo with Tim here, our head of customer value, and as always, Ingo, our co-founder and managing director. If you go to the next slide, there are some key facts about you. Ingo, you probably know already.
Did Jonathan?
I think Jonathan died, so I can do a little bit of an intro.
Okay.
So, yeah, welcome everybody. Yeah, Ingo and I happy to welcome you today. Ingo is our co-founder, managing director with more than 15 years of experience in pricing and really developed the Buynomics method. From my end, I'm leading the customer value team here at Buynomics. Previously worked in consulting. And yeah, mainly helping our clients really getting the value out of the platform. That's why also showing you the platform today.
Yeah, we need to get Jonathan back, or do you know how to do the surveys?
The surveys I'm not really familiar with.
Okay, let's see what happens.
Yeah, maybe to give also a quick overview. We were freestyling just a little bit. It's also going to be a fun session. So giving a little bit of an overview of Buynomics again, so I think Buynomics in itself is like a revenue growth and management platform and really enables better RGM decisions with like a very holistic approach, something that we're really focusing on also today. By that, like displaying very high predictive accuracy through this holistic approach and a very fast speed or very high speed to insight, basically. And all of that leads for most of our clients to significant profitability impacts between like 2 to 4% here. Good. Maybe the next slide.
Yeah, that's when I take over. So let's hope that Jonathan comes back. Otherwise, we don't know how to run this survey. I just looked, but I didn't find it. All right. So yeah. Also, thanks from everyone from my side. So I'm Ingo, co-founder, managing director, and the topic today, I think it's really core for what many of us are dealing with in the RGM pricing field. And that's the question of integration. We will today speak mostly about integration of different tools to cover different functionalities, but I think the topic of integration is much broader within the RGM field and is also one of the reasons, the reasons for being of the field, and the idea to integrate different questions. So not just look at pricing in isolation, but look at pricing together with price pack architecture, look at pricing together with promotion, and really look at all the levers holistically. And over the past few weeks, I've been at a number of conferences, fortunate enough to, I think, see the most of the relevant ones. Just came back from Canada, Toronto, earlier this week, where I was at the conference. And I think one of the main themes, and this is why we're speaking about that, we saw at these conferences is that there are many discussing different aspects of the integration that we also want to talk about here today. So there were, for example, topics like, and these are just some examples from the agendas. So how to navigate your cross-functional journey, focusing on the different functions that are being integrated within RGM, achieve success within holistic RGM, balancing the act within the balancing act of RGM, and so on. So really highlighting the different aspects of integration within RGM. And I think there are three basic things that have been integrated. It's the question of how do we properly integrate different data sources. We have all kinds of data that are relevant in RGM, from sales data to survey data and so on. The integration of different functions, looking at pricing, promotions, PPA, and other things together. and then also the integration or looking at effects together. If I increase the price of one product, how does it affect my other products in the portfolio? How does something my competitor does, how does it affect me? These are all the things that are relevant within the field, and we want to discuss this today. Also really happy to get your input. If you have anything to say on these topics, really looking forward to sharing. If you can share that in the chat. We have a Q&A session at the end, and we're really happy to discuss these topics. So to get everyone, I would say, on the same page here, let's start with what we're talking about in more detail. So I think the core idea here really is that in RGM, the core topic is how do we optimize or think about our portfolio. And our portfolio consists of many things. It consists of our products, our competitor products, at different product features like sizes, different flavors in this, different packaging, and so on in this case, different price points, different products that are being promoted or not promoted, and maybe differences between channels, how we work with our partners, our retailers, and how do we spend our trade money across different channels. So these are all the questions, and the core challenge really is that we have in RGM is to really bring this together, because historically these different topics had been addressed separately in many companies before they were being aggregated within to different degrees within a more centralized RGM functionality that tries to look at these in separation. So here's just as an example, as something we've seen quite a lot in a few years ago, that, for example, pricing was being done in marketing or finance, whereas promotion, trade spend, and so were being done in sales. There are many interactions, and that's why it makes sense to also discuss these topics holistically. But this really poses, of course, a number of questions. Where do you make decisions? What's the proper role of RGM? Is it more a support function that gives recommendations on what to do? Or is it really the function and organization that really makes these decisions centrally, and then the rest of the organization has to essentially go with that decision? So this is the one aspect, and the one we are more interested here is sort of the tools underneath these decisions, because it only, I would say, we can agree, makes sense to look at these different things together if you can also analyze them together. So if you can analyze what it means to change a price together with a price pack architecture change, or to change a price together with a promotion change. So this is essentially what we need. So, and I would say what in many organizations where many are in their journey is that having started with an RGM functionality, they're bringing together the different functions. What role is it? Just more support or really decision making, bringing these decisions together. And now I would say the core challenge is where many are, is also bringing the analytics, bringing the tools and methods together to really have an integrated understanding of these different effects. And this is really the challenge, because when we look at the landscape, we see in many companies, we see that this is not really the case. So, for example, I would say that the workhorse in revenue growth management really is still price elasticities, typically computed by some form of regression analysis. They've been used for consumer pricing or understanding base price changes, to some extent also understanding promotion effects. Then there are other tools like price ladders that help organizations understand how to set up or price their portfolio. There are other analysis when you look at promotions. Many work with some sort of uplift analytics for promotions, where you have different promotions that you ran in the past and try to understand what the sales uplift is that comes from a change in a promotion. And of course, particularly when organizations make larger changes in their portfolio, introduce new product sizes, many do or run analyses or surveys, like a conjoint, for example, or some shopper segmentation that takes more resources, and it's typically been done on an ad hoc basis with some sort of effort where you run a survey with some agency, get results as a one-off, use it, for example, to introduce a new product, and then move on. And then it's really typically really difficult to align the results of such an ad hoc exercise in form of a survey with an ongoing analysis that's, for example, been done in an analytics team that produces or tries to measure price elasticities in a company. And I think that Jonathan just came back at the right moment to run our first survey, because we're really interested in understanding what the situation in your companies is. Jonathan, can you hear me? Perfect. So here's the survey, and yeah, we're just interested in understanding if you can take a second to answer these questions, what type of tools and methods you're using within your organization.
Okay, I'm on my phone now, but yeah, the survey looks good at the moment. Let me check how many. We already got. We are at 60%. If we get 2 or 3 people more, then I close the survey, and then I can share the results with you guys. Okay, closing it now and sharing the results with you. What
Perfect.
do you think?
Tim, what do you think? Is that what you expected?
Pretty much, yeah. Price elasticity is strongest. I think that's very much to expect. Then price ladders, then promotion optimization, then contrast. I think seems in line with what I would have expected.
Perfect. Yeah, same for me. And also, as we said about the conjoint studies, that they're, I think, typically been run on a more ad hoc basis. And as we said, the workhorse, I think, really are price elasticities. So it confirms, but it's really interesting to see what's actually been used. And if you're doing something that we missed, really happy to know that. Just write it in the comments, and we can move forward. I think one topic here that we didn't address are the sort of the trade spend with retailers, which I think is probably a topic for a different topic for a different day here. And as today we want to look more at the end consumer side of things. So that's something we'll reserve for another day, and we'll come back to later. All right, I think it makes sense, and we do this quite a lot because I think it's an important topic. Because as we've just seen, price elasticities are really the workhorse, and they're really good. So in a simple case, so as in this example here, and I think it's always amazing how useful they are in these simple cases. So let's say we have a product, we have a price elasticity. So we know from measurement, if we increase price 1%, we lose 2% in sales. That gives us a price elasticity of -2. And if costs are 100 euros, then it's really easy to compute the profit optimal price, which in this case is at a price of 200. And this is because in the optimum, we always have the relationship margin times price elasticity is -1. So if price elasticity is -2, as in this case, the profit optimal margin is 50%. So if you are living in a world where there's only one product and you know the price elasticity of that product, in this case, it's the same at all prices, it's easy to compute the profit optimum. And the job is done. So it's good in the sense that it's easy to compute, but also bad, I think, for us as a discipline, because in a world like that, no really RGM teams are needed, because the solution is very simple. But luckily for us, that's only true in the simple world where there's only one product. If we have multiple products that we're managing, that equation again doesn't hold true. And also in the real world, we typically don't have constant price elasticities, but what we have are many things that are difficult with the price elasticity, right? So here, as a simple example, typically in most cases they're being computed via some regression analysis, and you get, with the particular, if demand is more linear rather than exponential, then what you find is that price elasticities are different at every price point. And you cannot then, in this case, really say the price elasticity of a product is -2, because it really depends on the price you're at. So you increase the price, then also the price elasticity goes up. And this is not because people have become more price sensitive, but it's just an artifact of how elasticities work. And in the case of a linear demand function, as here, you have essentially all elasticities between 0 at a low price to -infinity at the highest price where people still buy. So this is just to highlight also, as we've seen, it's really the workhorse. It's not that straightforward to work with elasticities because they change, and they're often also not too easy to measure. So you don't have a single price elasticity. So it's really can be very difficult or dangerous to work with price elasticity tables that you use for longer periods of time. Here it depends on the price, and if you have multiple products, it typically makes a difference if you change just the price of a single product or the price of all the products in your portfolio, and these things are really important. Another thing, because we're talking here about integrating different solutions, also I think it was probably the second most used, the price pack architecture, and we have it here in a very simple form. We have different products ranging from, let's say, we're selling peanuts at different sizes, 250 gram, 500, 750, and 1 kilo. And typically what you have is that you try to, when you price the different products, you, for example, look at the price per kilogram, and shoppers expect the price per kilogram to go down, different sizes. And typically what many teams aim for is to have some logic, some continuous function, or some monotonous function here, or it's a function that you can put on a straight line, for example, to price the different products. And here you can already see, and that's something that's quite common if you look at actual cases. You have a product, the 750, which according to the logic would be priced probably a bit too high. You would expect it to be more on the curve. But in this case, you have a price elasticity of -0.9. That means, remember from the equation before, if you increase the price, revenue and profit both go up. So it's not clear if that product should be on the curve, or just the price elasticity analysis would indicate that it makes sense to increase the price, whereas the price pack architecture analysis indicates that it probably needs to be a bit lower. And to answer that question, you also would need to have to consider the interaction of this product with all the others. So what I'm trying to say is that if you just use these separate solutions, the answers can be quite contradicting, and it's not clear what logic you want to follow here. Another example, let's put more into numbers here with the same numbers here. So often, and this is also something that I've seen quite a lot in the past, is that you have, let's say here, analysis based on elasticities. You have, let's say, -2 price elasticity. You have certain costs, and from that you can compute the profit optimal price, and then you use something similar to the price pack architecture, some value pricing approach, where you try to understand the value of different brands, different sizes, and compute the optimal or the right prices based on that logic. It can produce very, very different results, right? So if you look here at the end of the analysis, elasticity analysis in this example, particular for the smallest product, 250 gram, can be very different. And what I've seen more often than I hoped is that in such cases, teams often just take the average of such analysis. And this, everyone, I think, can agree is not the optimal way to price these products. And therefore, I think many teams that we speak with are really trying to improve and get an understanding of a method that aggregates these different logics. And this is really the second part of this presentation, that we want to understand how we can better integrate these topics into a single solution or a single method and solution that teams can really use to optimize holistically what they try to do. Before I hand over to Tim, just very quickly, because this is the method that's lying underneath our solution, is really what we developed, and I won't go into too much detail. We're happy to discuss this afterwards if you're interested, but it's really what we call the virtual shopper technology, and the idea is to create a very large number, depending on the context, hundreds of thousands or millions of these virtual shoppers, each equipped with specific preferences for different products, like real shoppers, equipped with different behaviors, so how they react to thresholds, how they choose between products in a good, better, best portfolio, for example. And based on that, having these hundreds of thousands of shoppers here indicated in this example with just these 3 shoppers, different utilities or preferences for different sizes, brands, and so on. You show them different products, and based on that, they make purchasing decisions. And if you, for example, increase or decrease the price of a product, you have a change in units, because based on their preferences, if you increase the price, let's say, of the smallest product, 250 grams here, some will switch to one of the other products, or they will not buy anything at all anymore. And this gives you your demand curves, or it gives you then, with the demand curves, you can compute price elasticities, you can compute revenue, profit, everything you're interested in revenue management. And this is really when Tim goes and shows an example what's underlying that technology.
Yes. Okay. Before we go into the live session, thank you, Ingo. We already have 2 questions, one in the Q&A section and one in the comment section. I would start with the one in the comment section. So Mikkel asks, when do you see PPA at PXKG level or RSP level?
So maybe I can answer on that one. When I understand it correctly, and please correct me if I do not understand it correctly, I understand that how we are handling it in Buynomics, if we handle PPA, so product changes ultimately at a price per kilogram level or at an RSP level. And the short answer is we are modeling on both levels. So the tool is able to let you know the right price for the product, not like at the kilogram level, and therefore also at the RSP level, and both can be modeled simultaneously.
Okay, thanks, Tim.
Do you want to do this second survey now or later?
We do it. We can do it just after the last question, and then we do the survey, and then we go into the live demo. So we have one question from Anna in the Q&A section, and she asks how elasticities work when we are increasing price by downsizing. Example, growing from 125 ounces to 105 ounces and keeping the same price.
Yeah. So formally, in that case, you don't have a price elasticity because you didn't change the price. You sort of have a size elasticity where you can compute the size change with the sales volume change. So that would be the case in our tool. It will only show price elasticity if there's actually price change, which is the right way to deal with that. So price elasticity focuses just on price changes, but there can be other elasticities, for example, a size elasticity.
Okay.
Exactly. And that's also a case that I will be showing now in the demo. So stay tuned. In a couple of minutes, you will see how that differs actually.
Okay, then we're eager to see it. So let me just start the last and second poll. Here it is. We're launching it. To what extent are your solutions, such as pricing, promotion, and PPA, interconnected and interdependent to achieve your overall business objectives? From 1 to 5, with 5 not integrated or not interconnected, interdependent, to 5 where you basically achieved full integration. Yeah, we see a lot of 1, 2, and 3s. 1.4 actually. We are at around 40% now. I probably will wait until we have 60% and I close the poll and end it. So everybody who is not taking part yet, please plug in your answer and then I can share the results.
Yeah,
Okay. Ending it now and sharing the results. Pretty much as we expected, right?
Tim, what do you think?
Yeah, quite interesting actually. I would have expected even a little bit more downstream, but yeah, like almost like 1 at 4, 0 at 5. I think that's pretty much the larger expectation here.
Perfect. Let's take a look, maybe, so that we stay within time.
Okay.
All right, then let's jump into the tool. I think today in the tool we have prepared a demo from an iced tea market, of course, fully sanitized. It's a market where the client is basically working in several retailers across a full year, and we are focusing on one retailer in that market and wanting to show a couple of scenarios, how it actually looks like when you combine certain levers and how a holistic modeling would actually then perform in that case. So let me share my screen. Ingo, I think you need to stop sharing for me to take over. Perfect. Here we go. Can you see my screen? Perfect. All right, so let's jump in. What you're seeing is the true Buynomics solution. I will guide you a little bit through. So how our solution works. Ultimately, you have basically your entire market available here, really on an extremely granular level. So what you see here is basically the products in the market, including your own products and competitors' products, and different prices, sales, revenues, distributions. And all of those really on a very granular level, so really per week. So you understand that the modeling here in our tool is happening on a per week basis with the different pricing, like such as promotional pricing in certain weeks and base pricing for all of the products. And in the same way, also the sales differ across those weeks. Here, this is the same for all the other products. What we can do now really in this tool is we can start modeling the changes. So now let's take the example that Ingo gave earlier, where there are different types of isolated changes in a way. So maybe only price, maybe only promotion. And I've pre-prepared a couple of them, but I also wanted to show one scenario just on the go. So let's introduce one of the other, like a new scenario, a demo. We introduce that here. So at the moment, we have our base case with our demo. It's like all the same pricing. I haven't done any changes yet. And we can now start doing, for example, a price change. So let's model what would actually happen if you change on a certain product the pricing. So we go through this flow here. We select here on the bottom, maybe the first one of the own products. Select that one and basically say we want to, for example, just for the sake of this demo here, decrease the price. Of course, in reality, it would be rather price increase, but let's keep it in that way. So we just type 4% of decrease, for example, and we add it here. Now the pricing is moving from 219 to 110. Of course, that's not fully accurate, so we might want to adjust that a little bit to make it 209, so like a real case in a way. Same here. We might want to adjust it to 289. And then we go next step and we simulate. So what's happening now is our virtual shoppers in the Buynomics model, they're actually reassessing the buying situation, and they're deciding anew how this price change would actually affect them. So what products they would now consider buying, and that really across all of the weeks that you have seen before. And I will show that now once the simulation is finished. And the nice thing about it is it's a very granular modeling. So on the lowest level, our shoppers are basically taking their buying decisions, and you can then aggregate, or you can view all of the KPIs very easily in an aggregated way here. Once it's done, here we are. We can see the result. So what we see here, when we overall a price decrease of 4% roughly on that product. Here that happens in each week. So I went from 299 to 298, from 219 to 29. Very simple. And that has an impact, right? That has an impact on the unit sales, but not just on this product, but also on the rest of the market, as you see here. So when we go on the absolute changes, you can really see that this product is gaining some sales due to the price decrease, but it gains these sales not just out of thin air, but really from the rest of their own portfolio as well as from competitors. So point is being that in a holistic modeling scenario, there's really a lot of interaction between your products themselves and your products and competition. And that was one example. I've, of course, created a couple of these examples, and I would like to show that now in the next tab here. When we click on this tab, and we might, for the moment, put all of them out. So what you see here on this tab is then a very similar case. So you see the base case that I've shown in the very beginning. Again, here we see the revenue across all the weeks for this one product that I just changed. That's here the base. And when I now introduce really this scenario that I just did, the -4% in price, you see here really the impact on a per week level. So you can really understand what's the impact, not just holistically on my product for the entire year, but rather on every part of the year. In the same way, the Buynomics model helps you to model different pack changes, for example. So what we've done is we've created another scenario, when I take this one out now, where we reduce the volume of the product from 1.15 liter to 1 liter. And again, we can very easily see here the impact, and that's related to what Anna asked earlier. So a pack change does not result in any price change, not directly, indirectly, yes, on a per kilogram basis, but not directly for the consumer. And just the volume change itself basically has an impact on the sales, and that can very nicely be modeled in the Buynomics tool. So here, again, that blue line, that was the price increase. Then here we have the size decrease in isolation. I've also created another scenario. Basically here, this was a promo change where we selected like very favorable weeks to adjust the promotional structure. And we did all of that in isolation, basically. So all of these three scenarios that you see here, they're all in isolation. But now you can actually model all of them at the same time. So the Buynomics solution gives you the option to not only look at them in isolation, but look at all of the changes really at the same time and see the impact on a very granular level. So here we have done the promotional increase, we have reduced the size, and we have decreased the price in this scenario. And you see here some of the weeks, like most of them, they're slightly below revenue. Then of course, some promo weeks, they're really favorable. And that's what we see on the sold product on a weekly level. And what we can do now, when we slice it a little bit different, can really see the revenue delta of these cases. So again, looking at the first case, the -4% in price, this boosts our revenue a little bit by here roughly 200,000. Then the size from 1.15 to 1 liter really decreases our revenue quite significantly. And the promo would actually increase again. The point is that these changes here, they are not just being added up, right? Just adding up these cases, that would be very, very much too simple, because looking at each of these levers in isolation, that's basically where the holistic modeling fails. But what we're doing here in the case 4 is actually the true modeling of all of these levers together within the same scenario, within the same market, and there's interaction between all of these levers. So this number here, the decrease in revenue for this one product, comes not as a sum of all of these numbers here, but rather as a sum of the levers that has been taken in a new situation in the market. And we can now look not just only at this one product where we see a slight revenue decrease, but we can also look at total products. So all of your own products, because there's always interaction, as you've seen before in the model, where we then see even a positive case. So in that case here, we see very clearly that the revenue is actually positively impacted by, so your overall revenue is positively impacted when you use all of the changes all together. In the same manner, you can also analyze the profit. So similar chart, just on the profit level. So for the one product, there's, even despite the fact that there's like a slight revenue decrease, there's a profit uplift. And again, we can look at all products in the portfolio and see overall it's still a favorable case. So that is something that you might want to pursue. And that's something you can really do in granular modeling. Great. Maybe Ingo, you want to say anything additionally to this case that we have looked at? I think it's a very interesting one.
Yeah, so I think it highlights two types of integration, the interaction between the different levers, because we're looking here at the size change, a price change, and a promotion change together. And we are also looking at the integration of effects, because we saw that we have a slightly different answer just when we look at that one product. In this case, I think the tendency, it was positive in both cases, but there are often cases where if you just look at a single product, it might be negative, but it might be positive for the whole portfolio. You get different answers, and this really allows you, because with this virtual shopper technology underneath that really replicates real shopper decisions and movements between products and the reaction to all of these changes, you can get a much more detailed and true answer to your questions. And that really gives you the flexibility and also the insights that you need to make much better decisions.
Absolutely.
Perfect. Should we get back to the presentation and then?
Yes, let me stop sharing my screen. Here we go.
Here.
The Q&A section, by the way, is buzzing. But yeah,
okay. Just to wrap this up, and then we go to the Q&A. So I think what we discussed was the topic today was integration within RGM, and I think there are three important types of integration. One is the one that we didn't focus on today, is the integration of different data sources, sales data, surveys, for example. That's also something that's possible with this technology, where you integrate insights from different sources. The integration of analytics, that's what we showed in terms of that we understand the interaction between levers and the interaction between products. And then this results also, of course, in the integration of decisions, where we can look at the effects of different measures together across different products levers. And in this example, we only looked at a single retailer, but we can do the same across different retailers. And as you've seen, the analysis, the results were for the full year, but the underlying analysis was on a much more granular, on a weekly level. And you can really use the microdynamics to get an understanding of how your measures affect the outcomes here. And this results in much higher precision of the outcomes, and in the end, in much better decision making. Let's go to the Q&A.
Yes, let's go to the Q&A. And I've picked 5 of the Q&A section to ask you. So the first one is, can the tool in the demo be used without weekly data, but rather monthly? If yes, what are the limitations and recommended minimum number of periods needed to feed the model?
Yeah, I can answer that. So short answer is yes. The model can also be used with monthly data. And here we look at typically as many data points as possible. We say normally 3 or more years of data is helpful. Ideally, a minimum of 3 to understand better seasonality and trend effects.
Okay, thank you. Next question is a rather short one. Is the modeling at customer or outlet level?
Yeah. Again, short answer, yes. The modeling is on a per customer level. So either per customer or per channel, it depends a little bit on how granular the data is, similar to the weekly and monthly question. And here in this case, that was just filtered down on one customer, on one retailer. But in the background, we had up to 10, I think in this demo was 10 different retailers with, of course, different effects in their reaction to price.
Yeah, you typically want to be at the level where decisions are made. So if, for example, you have within a customer different promotions by region, then that can also be replicated. Typically, the decision making is not at an outlet level in the end.
Thank you so much. The next question would be, does the model assume a closed market? So that means a fixed size of market, or does it build in a view of certain decisions, bring in category abstainers, hence growing the market overall?
Yeah. So there's no fixed market in the sense that there's a total sales of 100 units. There are always, as you can see, I think also in the example with the promotion peaks, that there is some flexibility. Not everyone who can potentially buy a product will buy the product each week, but if you run a promotion, you will have much larger sales. And there are differences between categories. So in some categories, if someone runs a promotion that primarily draws from other products in the category, so the whole category is more inelastic. There are other categories where if someone runs a promotion, that promotion mainly draws from outside the normal sales, so not from other products within the category, but really adds sales. And there are differences between categories. Some expand easier, some are more unresponsive as a total. And these are things that the solution learns from historical data, for example.
Okay, thanks. And then the second to last question, the impact on company results are clearly displayed and understood. Do you somewhere factor in the impact on category share, relevant metric, especially in times of volume pressure?
Yeah. Yeah, very good question. And yes, 100%. So within our tool, on the first part, the very detailed table that I showed, you can add any type of relevant KPI for you that you want to see, such as, for example, market share or also profit. So all of this information, like unit market share, volume market share, or revenue market share, sellout revenue, that's all possible to be displayed and can be analyzed.
Okay, thanks. And then the last question. Can profitability also be looked at in percentage terms, i.e., did the scenario increase margin percentage by 20 BPS?
Yeah, the same answer to as the question before. Margin is also one of the KPIs that you can add to the table and also analyze in detail. So yes, you would be aware if your margin has increased, decreased, or stayed stable.
Okay, and then a last one coming in super fresh. Does the solution factor in the customer view such that it could be used to drive a sell-in story?
Yeah, 100%. I think that's one of the very important parts that most of our clients also battle with quite a lot. So finding these win-win solutions to understand also how their customers would be impacted from changes. And we have that included in the model. So I was showing currently the overall the revenue and the profit, but you can slice and look at both sides of the coin. So the retailer revenue and profit, as well as for you as the manufacturer.
Okay, thanks. I think these were all the questions. If you have other questions, please feel free to write us on LinkedIn or per email or in any other way that we can be contacted. Should we go to the next slide to where I can show you, okay, we have a next webinar planned for July 5th, where we talk about the shift from descriptive to prescriptive and how we're transforming the analytics in revenue growth management. Ingo, you can elaborate on this, but I think this was one of the hottest topics, right, in the last POI events we had in Toronto and in Madrid, right?
Yeah, and I think it builds on what we discussed today. So yeah, looking forward to it.
Okay. Then, yeah, as always, you will get a follow-up email right after this webinar, and with the link to register for the next event, so you can already save the date in your calendars. Thank you so much, Tim and Ingo, for this insightful session, and thank you to everyone who attended today. Again, great engagement in the chat and in the Q&A function. I think this is where this community webinar really comes to life. And I hope you're pressing all your thumbs for a Germany win tonight, or if you're for Scotland, then for Scotland. Yeah.
Perfect. Yeah, thanks, Jonathan. Thanks, Tim. I think it was a good webinar. No one said key KPIs, and I'm also looking forward to the soccer match tonight. And yeah, fingers crossed to everyone, not just today, but also in the coming weeks if you're rooting for one of the teams.
Yes, thanks a lot, everybody.
Thanks. Have a good weekend.
Everyone. Bye-bye.